Hey guys, it's Cousin Richard. I'm back again with another video to help you learn how to be a better investor. And one of the most important things that I get questions on about is, how the hell did you go, Richard, from trading stocks to real estate? Like, how was that transition? Because stocks are just so different than real estate. I'm gonna tell you right now, the guys on Wall Street, they're not gonna tell you this, but all they do is take their profits from Wall Street and they invest it into real estate. That's what they do, right? They build buildings, they build apartment complexes, they buy investments that are going to pay them constant cash flow every month. That's how they sustain their lives, and they sustain their profits to then reinvest that money right back into the market. And that's what you should be doing too. Just follow suit with the exact same thing these guys are doing. Look, let's break down some of the important barriers and some of the tips that just kind of helped me go through this transition, right? When I first started with stock trading, it was pretty complicated because I didn't know what the terms were, or what it was all about, or how risky it was. And I'd been told by everybody that stock trading was, a gamble. And it is, don't get me wrong. It very much is a gamble. But you can have it more so be an educated gamble, right? Where you can understand a bit more about the companies that you're investing in. You can understand a bit more about the patterns that are happening on the chart. You can understand the psychology around the market and somewhat anticipate. I'm not going to say fully predict, but somewhat anticipate what the market is going to do within a minute, within 2 minutes, within 5-minute time period on these charts. So what I wanted to learn was, how can I don't want to predict the future. I don't want to be able to predict the next 5, 10, 15 days. I don't want to be able to do that. But what I do want to learn is how I can predict the next 30 seconds, how I can predict the next 1 minute, right? That to me was very important, or at least how I can anticipate it, right? So as a stock trader, I needed to learn something so fundamental that was going to level me up so that I could make good trades. And that's essentially what I did. I invested all of my time and energy, not so much on the fundamental practices of how to buy and sell, because that you learn over time. But what I wanted to learn was multiple strategies in a bad market that could help me be a bit more dynamic. So if I was in a bad market or in a good market or in whatever market, I could make money in whatever way possible trading stocks, right? So I was able to learn how to trade stocks long, trade stocks short, do swing trades, do dollar cost averaging, just very basic trading strategies, but nonetheless, a couple different ones that would work in my favor in the event I wanted to make money in one way or another, right? If a stock is going up, then I want to make money as the stock goes up by buying it long. But if the stock comes down, well, what do? Just sit on the sidelines? But I know guaranteed this stock is going to be coming down? Instead, I would rather learn a strategy that helps me make money as the stock is coming down, because there is a strategy which is called short trading. I could sell short that stock and I can make money as the stock falls, right? That is what I mean by having multiple strategies. And then when you use and have these multiple strategies, you can level up and you can use anticipation, right? So if I see a stock like, let's say, Uber or Bank of America, and that stock is on its rise, and I've seen it rise for a week, and I'm like, wow, this is unsustainable. It's likely not going to keep going up. Let me get out. Well, if I know guaranteed this stock is going to come down, why would I lose the potential earnings I could make by instead using the strategy to bet against the stock, meaning selling short the stock so that the stock comes down and I make money on the way down also. So I made money on the way up and I made money on the way down. That's double the earnings because I just educated a little bit more on trading stocks. You see, I also want to make sure that I can mitigate my risk. If I'm buying stocks as a long-term investor, which a lot of you probably do, then if I buy too high, well, then what do I do if I bought too high and the stock comes down? I just sit there and wait? No. I instead can do dollar cost averaging. I can start buying little by little on the way down. And I tell myself, all right, I know this stock is going to come back up, but I also want to get it at a better price. So if I keep on buying on the way down, my average price, my dollar cost averaged price is going to be basically the middle, sometimes, the middle of what I bought at the high and what I bought at the low. So now I have a middle average. So that'll give me, let's say I bought stock at 30, I bought stock at 15, now I have stock at 22, right? I'm just giving you an example. 23, just giving you an example. That is my average cost per share, let's just say. This is the way that you can dollar cost average down and lower your risk, but you also earn more shares because you're now purchasing more, and you have the potential to make more as the stocks go up. And if you're confident the stock's going to go up, then it's a good investment. It's a good strategy. It's a good strategy for long-term investors, right? So dollar cost averaging, really, really awesome. This is just a couple strategies I've just explained to you right now so you can learn a bit more about why it's so important to have these in your investor toolkit. Now, separate to this, the transition that I made was, all right, I already know a couple strategies. I'm making money trading stocks. What is the next thing I need to do? All right, the next thing that needs to be done is I need to preserve this money that I've made, not continuously throw it back into the casino. I need to take it out of the casino and put it into a storage. Now, the storage I would like would be something that can make more of it, right? So that it's not sitting stagnant. So I can make more money on the money. So if you put it in your safe, you put it under your mattress, that's not going to make you any more money. Essentially, it's going to actually bring down your value over time. But if you are putting it into a long-term passive vehicle that you know guaranteed is just going to keep going up in value, because let's be real, real estate isn't going down in value in the next 30 years. Like, real estate's going to keep on trending upwards because the scarcity of land we have on this earth, climate change is going to make that much more scarce, and there's going to be significant more demand because population density continues to rise. So you have a treasure sitting right under your feet that you right now should be investing in, and if you aren't doing it, it's a massive loss to you over the long run. So what I did was I said, I recognized that treasure 10 years ago. I decided to take my money from stock trading and buy that treasure. So I bought a lot of it, and I kept on buying it, and then I figured out a strategy to accelerate that buying, to have more buying power, using the bank's money to be able to fuel my rocket ship. That's what I did, and it worked out really, really well, because what I did was essentially use the bank's money to build my wealth fast enough that I could accumulate enough positive cash flow to be able to now fund not just my own personal life where I can go and live and travel and do whatever I want, but I'm also now able to use those profits to invest into the stock market and buy good deals in the stock market. You know, one of the things I've said time and time again is that people tend to run to a deal when Black Friday happens, right? At Macy's or at H&M or at all these different places. People run to those deals, they break through the doors and they go buy the TVs at Walmart, and it's just ridiculous. But when stocks are on sale, they're like, and they run away, and they don't want to invest in stocks because they think that everything's coming to an end. It's not coming to an end, people. Now you got to invest in the right things, because maybe it will come to an end in a lot of companies. But if you invest in the right things and you invest safely and you invest thoughtfully, then you're going to make enough money to be able to live 2, 3, 5 times better than what you were living when you just got started, because the compounding effect of value over time is going to continue to rise, right? I'll give you this example. If I made money in stock trading and then I invested in real estate will allow that money to now compound over time. I have appreciation growth, I have write-offs, and I have, plus principal pay down, and I have rental increases year over year. Rent never gets cheaper, rent always goes up. You may downgrade in life and consider that rent is cheaper, but that's not true. That just means you downgraded. But that still means that rent is just getting more expensive over time. It's going to continue to get expensive over time because not everybody and the majority of people in life cannot afford real estate, right? So those that can are going to get the best deals, and those that cannot are going to have to pay a lot more money in renting and lose money in renting. Now, going back to my example, when I put that money into real estate, the compounding factor over 5 years, 6 years, when I first bought my first investment property, that property gave me $3,200. Today, it's almost been 10 years of ownership. That property makes me $6,200 a month. So it's doubled in rental value. And that's monthly money that comes to me, and I didn't have to do anything. I still own the same property. I have only just maintained it, and the rent has doubled in value. So that's the compounding effect over time. Imagine you have 3, 4, 5, 10 properties. I have 36 units. So the compounding effect of that, if I were to raise right now on all 36 units $100, I make $3,600 a month. That means if I have a studio that is, let's say, paying me $700 and I raise it to $800, anybody will pay the difference there. If I have a studio that pays me that extra $100 across 36 different units makes me $3,000 plus more dollars, which makes me at the end of the year an extra $40,000 to $50,000. That's a lot of money for Richard that doesn't already do much in the real estate business, in the real estate investment. That's a lot of money for Richard to be able to make not doing anything. You know, that's a very, very powerful thing. So you want to be conscious of compounding value, and you want to use leverage to make the compounding happen. I also use leverage by trading stocks, right? I used margins. So I used the bank's money in order to make my trades. And then I compounded that. Now, if you guys are interested in that video, then you can go ahead and click on one of my other videos here in our YouTube channel, and you can educate a bit more about my stock trading strategies and my real estate strategies as well. All right, guys, if you guys like this video, please like or subscribe, and go ahead and, you know, join our channel. Comment below if you have any questions, and I'll go ahead and answer them for you. All right, guys, see you soon.